Joining us now is Senator Steve Daines of Montana. He is among a group of senators who introduced legislation this summer aimed at protecting retirement funds by detailing the fiduciary duty of plan administrators to select investments based only on financial factors. Senator, great to have you on the show again. Welcome back.
Hey, good morning.
Good morning. You say that there are many studies that say that investing with ESG in mind doesn't pay off as well. I'm wondering what studies they are, and if you can just sort of lay the groundwork so we can understand how, those who have retirement funds that are invested in this style are missing out in terms of returns.
Sure. Well, you think about a retiree, they're primarily interested in return on investment, growing their portfolio, and that requires a focus on fiduciary responsibility and rate of return versus appeasing the woke left in some of these ESG priorities. The bottom line is, as we look forward, and we're seeing this right now around the world, as we're seeing the energy crisis that's unfolding now in Europe, the energy inflation we're seeing here in the United States. You go back to policies that governments putting in place, particularly Germany, started to shut down nuclear plants, shut down coal plants, and now they've got a crisis where Germany's electric prices are 10 times what they were a year ago. Europe is in real trouble. And this is moving from just a energy inflation now to literally life and death as we move into the wintertime. These kind of ESG policies where you have woke government leaders who are putting pressure on companies to adopt these woke policies to shut down carbon type sources of energy which are affordable and reliable. This is a huge problem, and it creates risk as it relates to financial return.
I understand that. In terms of if you're a retiree and let's say you're sitting in the state of New Jersey or New York or wherever you want to cite, Senator, how are you missing out? I mean, are there certain retirement funds out there, or are there a number of assets that you know of that are invested in ESG, and so therefore you can say these investors are not getting as full returns as they may have if we were able to ignore ESG?
Yeah, well, we encounter those challenges as we, in the committees I serve. I'm on the finance committee, the banking committee. We bring leaders in from banks, for as an example. Are they making an investment solely based on what's best for their shareholders versus as stakeholder craziness? It's the shareholders that ultimately matter. When you own a stock, you are a shareholder. And as somebody who worked for 28 years in the private sector, including for a Fortune 50 company, our responsibility is to our shareholders to ensure we maximize return on investment.
Isn't that what fiduciary means, though, Senator? I mean, as somebody who administers a retirement fund or is in charge of, is a CIO of a retirement fund in the state, doesn't fiduciary in and of itself mean that their primary interest is the return on investment, or should you actually go after the definition of fiduciary as opposed to specific policies?
Well, you're exactly right. It's the return on investment, and the challenge we face is these stewards of these funds, retirement funds, as an example, are basically trying to earn brownie points with the left and their woke agenda versus solely focused on fiduciary responsibility. And that's why they'll say that climate change is perhaps the greatest financial risk we face moving forward. Well, that moves into really more of a political discussion versus where's the best place to invest the dollars for retirees to ensure they maximize their investment and the return on investment.
So, Senator Kyle here, when you talk about, you can separate the politics actually from the fiduciary role, right? And I realize that there is a political argument here, but if you think about the fiduciary role, you're right when you say that either retirement funds and/or endowments and pensions aren't making investments in hydrocarbons today because their boards are subscribing to this policy of wanting a better climate and want to follow climate policy. But if they strictly followed the rules of their fiduciary responsibility, they would have to be investing in things that have IRRs of 50, 60, 70% that are actually sitting out there in the oil patch today. And how do you think about separating just that fiduciary role from the political side of things?
Well, that's precisely the outcome we want to drive here with these policy changes. You look at what's going to go on in the world over the course of the next 30 years. Between now and 2050, the demand for energy globally increases 50%. Oil, coal, natural gas will play a significant role for the next 30 years. Germany, in fact, just had to pass a law in the last 2 weeks allowing coal plants to come online for the next couple of years to try to bail Germany out. And that's exactly what needs to happen as it relates to fiduciary responsibility for retirement accounts, to focus on what is the best thing for return on investment. As you go forward here, oil, natural gas, coal, these companies are going to be doing very well going forward, but the stewards of these plans should be solely focused on what's best for their shareholders, not what's best to appease some green ideological agenda. And if there is a great investment in renewables, and I support renewables, we should view renewables, though, as expanding our energy portfolio, not replacing baseload power. And that's precisely why Germany and Europe's in the crisis they're in today, because they radically move forward on these left ideological green energy policies. And now the people are suffering across Europe, and they are facing a huge energy crisis as they enter the winter.
Senator Daines, great to have you with us. Thanks so much for your time.
Thank you.